area, and we'll go a little bit in more detail. Let's review a little bit with regard to the balance sheet here. First of all, it reports a company's financial position, and that's why some companies actually call it the statement of financial position. And as you know by now, you have your assets, liabilities, and stockholders' equity listed on the balance sheet. And in more detail, we'll talk about breaking down assets between current and long-term, and the same with liabilities. As far as our balance sheet is concerned here, notice they do have a section called current assets, and we'll get into why we call certain assets current and why we refer to other assets as long-term. But some typical examples that we had in the past where you have your cash and cash equivalents, accounts receivable net. When they say net, they mean after somebody's estimating bad debts. So when I say there's lots of estimates involved in accounting, you bet you somebody's estimating a percentage of your receivables, well, that will not be collected. And by the way, I forgot to mention, what do we mean by cash equivalents? These are treasury bills and CDs that are going to mature within 90 days. Most companies won't list those out as a separate line item, but they're not going to let all that cash, especially if you're talking $1,093 million. This is in millions. So that's $1,093 million. You're not going to just let that sit in your checking account where they pay you a tenth of a percentage point on interest. So they invest that money temporarily and then, of course, use it accordingly. And then whenever it matures, they'll have enough money, of course, to pay their bills. Inventories, there's different ways to account for your inventory. There's different methods. Prepaid expenses is pretty straightforward, but all of these items are what we call current assets. And we'll get into shortly why we call them current assets. Things like property and equipment are going to last a little bit longer, but notice they say net. So when you're looking at the $672 million number, that is after you've been depreciating it for a number of years. So think about it. Older companies are going to have assets, especially property and equipment, at a much lower amount. When they say property, they mean land and buildings and then all the equipment items. They have some leases that are involved in, that they're such long-term in nature, they list those as assets. Intangible assets, things like goodwill, copyrights, patents. Then other long-term assets could be long-term receivables, as well as some long-term investments. And they get a total of $1,473 million, so their total assets are $3,281 in all. Now notice we break down our liabilities just like we did with our assets. We have current assets, things like accounts payable, what you owe your suppliers, accrued expenses, unpaid wages, unpaid interest, current lease liabilities, what you're going to have to pay within the next year on your rentals, taxes payable that you owe the government, deferred revenue, that's a new one for us. Notice it says deferred, meaning it's not ours yet. So if you're selling gift cards, that's not yours, your revenue, until you actually have that customer coming in, cashing in that gift card, and taking those particular items. And then they have some other current liabilities where they were rather small in amount, but they added up to $125 million. And notice they broke down your long-term liabilities between long-term lease obligations, some taxes that you're going to owe in future years, as well as some other long-term liabilities. Could be, of course, with regard to maybe bonds or some notes that you actually signed or a mortgage. And, of course, our common stock, nothing new there. We have what we call common stock. And notice that amount is only $1 million because there's a so-called assigned par value to it. And the additional paid in capital, what those shareholders paid in over par, is $355 million. And that's why companies like Apple don't even bother breaking that down. They just say investments by shareholders, and they have the total line, or they just say common stock and don't even show you the additional paid in capital. But basically, Lululemon here, their shareholders invested $356 million in the company. And notice they've been around a little bit, and their retained earnings is much higher than the investments by shareholders, as I stated in prior chapters. And they have some accumulated other comprehensive income or loss that we don't care to get into. Those are just gains and losses that we did not run through on the income statement just yet. And notice if I add up the total stockholders' equity and liabilities, I get $3,281 million. So that's basically what a balance sheet almost looks like out there in reality. And then, of course, you'd have note disclosures breaking down your property, equipment, and how much is in accumulated depreciation. Likewise, in the notes that tell you how much we're speculating as far as doubtful accounts. Then they tell you things in the notes about what inventory method you're using. But the liability numbers are a pretty solid number. When it comes to the asset values, that's a different story. Those are not market values by many means. Of course, your elements are, just reviewing that again, assets from the first chapter, they're economic resources, they have value, service potential. These are all your obligations that you have to pay out monies for services, borrowings, and so on. And of course, your equity, we often call that your net assets, because if we take the assets less the liabilities, we would come up with stockholders' equity. Now, under assets, we break them down between current and long-term. Liabilities, we do the same thing, and yes, your stockholders' equity, invested capital, as well as then earnings kept in the business. Question for you here, the residual interest in assets of an entity after deducting liabilities is referred to as, hopefully you get this one right, I hope you're thinking right away, letter D, equity. Because if I flip liabilities over to the left of the equation, subtract that from assets, I get the stockholders' equity. And many people refer to as stockholders' equity as net assets. That's not uncommon to hear people say that. Let's talk about economic resources of a company. First of all, with regard to your current assets, and of course then your long-term assets. The idea behind current assets is this. They're going to provide a benefit to you within the next year. Whereas long-term assets, as the name applies, it's going to benefit you for more than 1 year. And that's the guideline that we use, 1 year. So current assets include things like cash and any assets that are going to be converted to cash or used up within your normal operating cycle. And most companies have an operating cycle that is very short. If you think about a grocery store, their operating cycle by the time they buy their inventory, sell it, and then collect the money is very short. Even a clothing store, let's say if they just only stock for once for each season, they have 4 operating cycles within a year. And of course, they would use that as their guideline if that's longer than 1 year. For example, in our cases, we're not going to worry about it, but a defense contractor or a construction company, their operating cycle may be 2 or 3 years by the time they actually close on a job, actually have it completed, and then get paid for it, especially with defense contracts. And that's why we define the operating cycle here. It's for the period of time from where you purchase the inventory and until you sell the item and collect the cash from the customer from the sale of that inventory. And sometimes if you're a home builder, that obviously is longer than the 1-year period. As far as Lululemon, their current assets look like this. The cash and cash equivalents that we saw before, the accounts receivable net, the inventories, and the prepaids. That gave us the $1,808,000,000. So that's what you typically see on a balance sheet. With regard to long-term assets, as I previously said on another slide, they're going to benefit you for longer or a period greater than 1 year. These would be things like long-term investments. Other companies will buy other companies' stocks or bonds. Property, plant, and equipment. By property, we mean land and buildings and so on, and then the equipment. Those are long-term assets. They're not going to be used up within 1 year. Same with any kind of lease. If you're leasing that item for a long period, even though you don't own it, you're going to list it under your assets. Intangible assets such as copyrights, patents, franchises, and other being long-term receivables that you would typically list under other. So that's a good listing of what you actually see under long-term assets. On the balance sheet for Lululemon, going back to that, you had 4 of those items there. You had it net, meaning after depreciation, and keep in mind the age of the company is a big issue here. Younger companies are going to show much higher asset values for property and equipment because why? They just bought them recently at higher amounts and have been depreciating them or writing them off over a number of years. Same with operating leases, intangible assets, you're writing those down as time goes along, and your other long-term assets for the total amount. When it comes to asset measurement, it is kind of confusing to users out there. Most assets are going to be reported at historical costs, being their original transaction value, when you're looking at things like land, buildings, and equipment. Now, when it comes to buildings and equipment, true, they're recorded at historical cost, but we write them off over the period's benefit. So as we say here, it's the cost of an asset, the historical cost, but we're going to write them down by depreciating them or amortizing them, which is only fair. If that asset lasts us 10 years, then we're going to write it off over a 10-year period. And when you take your 201 course, you'll see different methods of depreciation. You'll study financial accounting in a lot more detail. Net realizable value, when do we do that? Well, what is it, first of all? It's the net amount of cash which an asset could be converted in ordinary course of business. So when we say net realizable value, oftentimes your inventory is valued at that. Where you say at the end of the year, what I can get for this inventory, is it a lower amount than what I have them recorded for? And the answer might be yes, especially if replacement prices actually have gone down. Don't assume everything is subject to inflation. When it comes to fair value, that's sometimes used for certain assets, especially your investments, where since historical cost is no longer important, you look at fair value of an investment. You say, well, what is that worth now? And we write them up or down at the market value or present values, which is a little beyond the scope of this course right now. Turning our attention to liabilities, we all know that those are obligations, monies that we owe to other entities. We also have 2 classifications. Current liabilities, the key is they're due within 1 year of the operating cycle, although as far as the balance sheet is concerned. Long-term liabilities are due in more than 1 year. So it's that simple. It's the same kind of classification as current and long-term assets. As far as what we saw before with regard to Lululemon, on their balance sheet, they had quite a few items here. Even something new for us is deferred revenue. Then why are we calling these current? Because they're all going to be due within the next year. And then, of course, we had some long-term liabilities. Classic examples of current liabilities, yes, accounts payable. Oftentimes you'll hear deferred revenues being referred to as unearned revenues. When they say deferred, they mean they're putting them off as showing them as revenues right now on the income statement. So unearned revenues are basically the result of when a customer pays you in advance. For example, let's say you have a membership club at something like LA Fitness. In that case, they would not record that all as revenue right away. They would pick up pieces of that as revenue over each month over the next year if you had an annual membership. Likewise, if you pay for anything in advance, when you're paying for your insurance in advance, even though you might say I'm paying it monthly, you still are paying it for longer than that. That insurance company is picking that up as unearned or deferred revenue as a liability until the time passes by, and then they pick that up as earned as the months tick by. Accrued liabilities would be things like unpaid utilities, unpaid wages, unpaid interest, unpaid taxes, and yes, you'd also have the current portion of long-term debt, which is something new for us. So watch out on this particular one. There were basically three types of liabilities we didn't talk about before. The deferred revenues, being that customers paid you in advance and you have yet to earn the money. Accrued liabilities, and the current portion of long-term debt. As far as accounts payable are concerned, that's pretty basic. You're buying something from your suppliers, whether it's supplies or inventory, you usually have 30 to 60 days to pay. As I said before, with regard to deferred revenues, the customer paid you in advance. You received cash from customers before you provided the service to them. Classic example is a gift card. So whenever you buy a gift card, that retailer cannot pick that up as revenue. They have to show a liability for that, because later on, whoever comes and redeems that gift card, that's when they'll show the liability going down and picking it up as revenue. Accrued liabilities, like I said on the previous slide, they can be things like salaries, interest, taxes, utilities. They're created when the expenses have been incurred. So that's what we mean by accrual accounting. In other words, accrual accounting, you're picking up expenses even though you haven't paid them yet. Likewise, you're picking up a liability when it comes to your deferred revenues before you actually earn the money, because you're collecting that in advance. So that's the whole idea of accrual accounting. Accountants are recording expenses even though no cash left the business, and that's a big distinction between the income statement and the cash flow statement that we'll talk about a little bit later in this chapter. But I wanted to relate that to you right now. These are examples of accrual accounting. You're recording expenses even though you haven't received the money yet. Think about accounts receivable. If that goes up, you're picking up the revenue, but you haven't received the cash just yet. That's another example of accrual accounting. When it comes to your current maturities of long-term debt, for example, that portion that's becoming due within the next year, that is going to be listed as a current liability. So let's say you have $1 million note payable requiring 10 payments of $100,000. $100,000 of that would be current. The other $900,000 would be long-term in the very first year. And as you see there, exactly what I said, breakdown, and you'll see a breakdown on the financial statements between current and long-term liabilities as they become mature. Some other examples of long-term liabilities, well, besides just the note that we talked about, bonds are a classic example. Lease obligations, where you're leasing something out and you're liable for several years to pay the rentals. All companies that have pension plans have pension obligations, which are long-term in nature. You could even have warranty liabilities. Think about an automobile manufacturer. If they offer you a 4-year warranty, as some of the German car makers do, or Hyundai, would they have a 5-year bumper-to-bumper warranty? 1 year of that is current. The other 4 years for Hyundai is all long-term liabilities. Here's a good question for you. Which of the following is not an example of a long-term liability? As you read through the list, I hope again that you see it immediately. Yes, accounts payable, because that's due within 30 or 60 days normally, whereas all the other three, A, B, and D, are what we call long-term liabilities, and that being things like your pension obligations, your bonds, your leases, and so on. Stockholders' equity. As far as the equation is concerned, we just flip it here for you so that you start understanding that stockholders' equity is really net assets. If I take assets less liabilities, because I moved it over from the right side, I get my stockholders' equity. And yes, under contributed capital, you now have two components. I talked about this a little bit before. Common stock is the so-called par value that provides some protection to creditors, but sometimes it's ridiculously low. It's a tenth of a penny or even a hundredth of a penny. So it provides little protection, and a lot of companies don't even bother breaking it down between common stock and paid-in capital. But the two of them together is what the shareholders invested into the company. We all know retained earnings is income kept in the business after dividends. And then you have this accumulated other comprehensive income, which is gains and losses that have not yet been run through on the income statement. Lululemon, as we saw before, shows you the common stock, the additional paid-in capital, the retained earnings, and then, of course, they had some other comprehensive income here, or a loss, I should say, of $225 million. And you might be saying, well, why don't they run that through on the income statement? It could be long-term investments. And if they're long-term investments, yeah, we might have a loss this year just because market prices are down on our investments that we took, but next year they could bounce back up. So if it's long-term in nature, why mess up the income statement with temporary gains and losses on long-term investments, or even pension obligations, which are a lot based on the market? There are limitations to the balance sheet that we already spoke about. First of all, it tells the company's book value, which is basically the assets less the liabilities, gives you the company's book value, what their stockholders' equity is, versus what the market value is, which is the estimated selling price of that company on any particular day, looking at the value of their stock and the number of shares actually outstanding in the hands of shareholders. So those numbers are going to be significantly different. And also there's a lot of estimates and judgments made when you're recording assets as time goes along that we'll address on the next few slides. I need to elaborate a little bit why the book value is different than the market value of a company. As I mentioned on the previous slide, many of your assets, in fact most of them, are listed at historical cost rather than the amounts the assets could actually be sold for today. And some of you might be thinking, well, why don't we just show them at their market values? The reason for that is it's very subjective to say, well, what could we get for this land, or what could we get for this unique plant site where there's nothing to really compare it to. So that's why the accountants stick with historical costs. It's verifiable, it's very objective what we paid for it, versus somebody guessing on how much that asset is actually worth. Also, when it comes to a company reporting their assets, some certain assets are not even recorded on the balance sheet and have a zero book value. For example, what if you're more profitable than other companies? Some companies cannot go and estimate that inherent goodwill. The only time you get to record goodwill is if you bought out another company for more than what it was reflected at on the financial statements. So there are situations like that where we have, let's say, a patent that is worth a lot more money than what we paid to either acquire that patent or develop it. So there's issues like that where not all of your asset values are really reflected. And on the opposite end, some assets could actually be overstated a little bit. Because think about buying, let's say, a truck. Once you use that truck and you're writing it off over 5 years, odds are you're not going to be able to resell that in a year for 80% of its value, especially office furniture, if you think about that, or a computer. Try to turn around and sell your computer 1 year after you owned it. You'll get a fraction of what you paid for it. And also, when it comes to market values, there's a lot of expectations on the part of investors about the future growth of that company. That's why they look into the future and are estimating how well can that company do in the future, and certainly that's not reflected on the balance sheet. And once again, I just want to elaborate the number of estimates that you actually see on a balance sheet, which also then affect in turn your income statement. Accounts receivable, you might think, well, that's the amount customers owe you. But somebody out there, especially your retailers, where they literally have hundreds of thousands of customers, they're guessing on past experience what's not going to be collected. Inventory, even when it comes to obsolete items that cannot be sold, do they really know at the end of the year that that item is obsolete or we're going to have to mark down the price? And also, you're using different inventory methods that you'll study in your next course. Property, plant, and equipment, you're actually writing that off over a useful life, and who's to say how long that asset's going to last you? And then you're allowed to use different depreciation methods. And then, believe it or not, accountants are guessing at a salvage value. Say you bought some equipment for $100,000, they might be guessing that it's going to be worth $10,000 in 5 years, so they only write off $90,000. Again, it may not last you 10 years, and you may not get anything close to $10,000. So you need to be aware that a lot of the numbers you see in assets on the balance sheet are rough estimates. And also investments, well, I don't really, that fair value of the investment is going to fluctuate, obviously, if it's in stocks or bonds. Warranty liabilities, another classic example. You don't know for sure how much your warranty claims are going to be, but you're guessing because you have to accrue that as an expense. So again, I just want to leave you with the idea that when you look at that balance sheet under assets, a lot of those asset values are subject to significant estimates, and they're not anything close to the market value. Typically, you'll see a company reporting their profit or loss for the year, or then maybe on a quarterly basis. But it's not just the revenues, it's all the gains, and then it's not just the expenses, it's all the losses. And the key is, from what we said in the last period, the income statement is for a period of time, unlike the balance sheet, which is as of just one day. Your authors condensed this income statement a bit, but first of all, when they say sales revenue net, okay, net means after any returns and discounts you gave customers. So that's always what they mean by the word net there. That you're going to have returns, you're going to have discounts. Cost of goods sold, how much it cost you to buy those items. That gives you your gross profit. Then many companies just combine selling, general, administrative expenses all as to just one line item. And after your operating income, because some people like to look at operating income as their number for comparative purposes, they show you your other revenues and expenses that deal with more financing and investing activities. You had some expenses there, or maybe a loss or whatever on selling some equipment. That was some $8 million. Then your income tax expense is always listed as a separate line item, and finally you have your net income. We did not say much about gains and losses in the prior chapter, but gains and losses do either increase or decrease your net income. And some examples. You could actually have a gain or a loss arises when you're selling off some investments. Property, plant, and equipment, maybe selling any of those for a gain or a loss, that differs from their recorded amount on the financial statements. So those are listed as separate line items. They don't go under your operating income. As far as the income statement and the various components, we've already talked about in the last chapter as well as this one, gross profit. That's simply your sales less your cost of goods sold. Your operating income includes your gross profit less your operating expenses, as we saw on the income statement for Lulu. Then you have your non-operating income, which has nothing to do with daily operations. It's more investing or financing in nature, where these are your revenues, expenses like interest revenue, dividend revenue, if you have investments in other companies, interest expense, gains and losses on selling any assets, land, buildings, investments, and so on. That would fall under non-operating income. Then you, of course, have your pre-tax income, which is the sum of your operating income and your non-operating income. And finally, after you back off your taxes, you get your net income. So we actually have those different categories on your income statement. Very important number that's probably overused in accounting is something called earnings per share. The reason you have it, it makes for relative comparisons among companies of different sizes. So that's the key. You can compare a small company with a large company. And yes, you'll see it's very confusing out there where companies disclose both basic and diluted earnings per share. Always my advice to any of you looking at the financial statements is look at diluted earnings per share. And the disparity between the two are just a few pennies. It's not that big of a deal. So your basic earnings per share is real simple. You just take your net income, less any preferred dividends if you have preferred stock, and you divide that by a weighted average number of common shares outstanding. And you might be saying, what do you mean by weighted average? Well, if you started out with 1 million shares and ended with 2 million shares, you don't want to divide by 2 million because you didn't have 2 million outstanding all year. You look at the average of that and you divide by 1,000,005. That's all. But earnings per share is a very important number. In fact, some people look at earnings per share way too much. And I have to caution you that accountants can play a game with you here and mislead you into thinking earnings per share is actually increasing. Think about this. What if we go out and buy back some of our stock? Say all year, or last year we had 1 million shares outstanding. Say this year, our income number's basically the same as last year. But we decided, okay, in order to prove earnings, we're going to buy back 200,000 of our shares in the market. So if we're dividing by 800,000 versus last year 1 million, obviously our EPS number is going to go up, and maybe we borrowed the money but buy back those shares. But companies will do that. They can buy back their stock and improve their EPS number. So you've got to be careful in how they manipulate things. Diluted earnings per share, your authors talk about it. I don't want to go into too much detail. By that we mean some companies have things like convertible bonds, convertible preferred stock, and stock options. So with dilution, they treat those as common shares, basically. So think about it. If you increase your denominator, as we say down here, when you're dividing that into net income, you're going to come up with a lower EPS number. And typically the distinction between diluted earnings per share and basic earnings per share, I've never seen anything more than 6 cents. And it's a very small percentage. So I think there's just way too much emphasis on so-called diluted earnings per share. But use that number instead of basic. Why? It's a little bit lower. And I'm always skeptical in thinking that companies want to show higher earnings rather than lower earnings. So I use the lower EPS number diluted for comparison's sake. Also, there's 2 formats that you'll see companies using out there, and neither is acceptable under GAAP. You have something called the single step form, where all you have is every revenue is listed first, likewise your gains and everything, and then you deduct all your expenses and losses. You're going to get the same net income number no matter which approach you use. Now, the multi-step is what we've been talking about, where you have your gross profit, then your operating expenses are listed, and you have your operating income, then you have your gains and losses and other revenues and expenses, and finally you have your pre-tax income, and you back off your taxes to get, of course, your net income. Single step. I see those off and on, not as often as multi-step formats, but you might see them in 1/3 of the cases, a single-step form income statement versus a multiple-step form. And certainly with a service-type company, you're more than often going to see a single-step format income statement, just because you don't have a cost of goods sold number. There is something out there called income from discontinued operations. This is way different than these non-operating items. There is a situation where, as it says, the company is discontinuing a certain segment or a big component of their business, that they sell it at a gain or a loss. So what they do is they break it down. They show you the income or loss from that division this year, and then they show you a gain or a loss from the actual sale of all the assets. So again, the key is a component of the entity or a group of components have been sold or disposed. That income or loss from the discontinued operations is shown as a separate line item on the income statement. And instead of just talking about this, let's look at what it actually looks like on the next slide. With Abbott Laboratories, your authors grabbed, and again, this is in millions. They had $34 billion in revenues, cost of goods sold of $15 billion. Then they don't even list out the gross profit. They figure that, hey, this is a single-step income statement approach, more or less. They have the selling and administrative expenses. And then your research companies do this. Research and development is often included under selling, general, and administrative expenses. But these companies like Apple, too, and any pharmaceutical company, want you to know how much they have to spend on R&D each year. So they list that out as a separate line item because really it's an investment in their future. Then they come up with their operating income of $5.35 billion. They have some other expenses there, 389. They come up with income, what we call continuing operations. And that's the first time we've seen that. A company referred to as income from continuing operations. And the only reason is we got some discontinued operations. So they show you the tax on that and your income from continuing operations. And then the accountants will break it down for you, how much the loss was, and then the net effect of taxes on it. They usually have that in parentheses for $24 million. And if you're thinking, well, why did they do that? Because think about this discontinued operations. Is that going to continue again in the future? And the answer outright is, of course not. You're not going to have discontinued operations each and every year like these other items up above. So that's why they list it out as a separate line item, because when you're predicting earnings into the future, you don't want to use $4,495,000. You want to use $4,471,000. And sometimes these discontinued operations can have a significant impact. For example, General Motors a few years back actually abandoned their Lordstown plant up in Ohio. And that was a huge, huge amount for discontinued operations. And you see sometimes large conglomerates divesting. There are problems with the income statement as well when you look at it. First of all, as a user, you're seeing recurring and non-recurring items in one statement. Talk about discontinued operations as being an example. So you have to keep that in mind when you're making comparisons and projections of your earnings. Use, of course, income from continuing operations. Then you go at the inclusion of operating and non-operating items. For example, when you have your gains and losses on the sale of assets. They're listed on there, but you got to remember, that's a non-operating item. You're not in business to sell assets at a gain or a loss, or an investment at a gain or a loss. You're in business to generate sales, and of course you incur expenses because of it. And then you have potential errors, and your authors often call this misuses. Misuse almost means like you're doing it on purpose, but you have loads of errors in your estimates and judgments as to how long you're writing an asset off over, or how much your warranty liabilities are, or how much bad debt expense is going to be. So when you see that income number, take it with a grain of salt. It's a rough estimate. It's not exact. If you had another accountant doing the financial statements, they may come up with a different dollar amount for your income. Hopefully not too much different, but again, it wouldn't be the same figure. Of course, next we have our statement of cash flows. Some basics about it that you should keep in mind. It's required. You have to, whenever accountants prepare the annual report, along with the balance sheet and income statement, they have to show a statement of cash flows. Very simple. You're saying just the cash receipts less all your cash disbursements. That's going to give you your change in cash for the period. And it's very useful in predicting future profitability. Not only that, liquidity. That's why I mentioned you have to have a strong cash flow from operations, and even long-term solvency, because if you don't have enough cash from operations to cover your investing outflows, you're going to have problems paying off your debt. So that's why that statement is so important, and probably I find it to be the most useful financial statement. As far as categories, you have your three that we mentioned earlier, your operating activities, investing, and financing. This is the most important category to me, because this is going to impact how you can invest and how you can finance, whether you're going to be paying off debt, paying out dividends, or even being able to buy back your stock. As far as some basic inflows from operating activities, let's review those. Sale of goods and services to customers. You might have some interest in dividends from investments. They would go under operating activities. And those would be from investments that you have. Cash outflows, obviously you're purchasing inventory. You're paying out wages and other operating expenses. You have interest on debt. You have income taxes. Those all deal with daily operations. So that's an important number. How much cash flows can you generate from operating activities? And sooner or later, you've got to show a positive number, otherwise you'll be out of business. You can't continually borrow or issue stock to finance operations. With Lulu here, let's see if they have a strong cash flow statement. I like this one because it's an actual cash flow statement, and it's good for you to start interpreting things when you look at these numbers here. In this course, we don't even attempt to tell you how we convert net income to a cash basis. But first of all, am I happy with that number? Well, one thing you want to look at always is, what's my net income? Well, that's good news. It was a positive number. The other good news is that my cash flows from operations are a little bit higher than that number. So that tells you right away that a company has good quality earnings. When you see cash flows are much less than net income, that's a sign that the company does not have good quality earnings. So one thing I always want to look at when if somebody says, how's that company doing? I don't go to the income statement. I go to the cash flow statement and I see, do they have good, strong cash flows from operations? And then don't think that a negative number, in parentheses, is bad news. I want to see a company investing. And they had purchase of equipment of $283 million and some other investing activities. And the real good news here is their cash flows from operations cover that, meaning that they don't have to borrow money or issue stock to cover their investing outflows. So they're living within their means. And then, of course, you have your cash flows from financing activities. Am I happy with a negative number? Always. Because when I see a negative number, that implies, well, they're paying taxes on some employee stock options and they're getting some money from the employees for exercising stock options. But this company has enough money to buy back their own stock. When they say stock repurchase, we refer to it as treasury stock. You'll learn about that more in 201. They spent $173 million out there in the market buying back their own stock. Now, obviously, if they do that, they can probably increase the earnings per share that I talked about earlier. But notice, they were able to finance all of that just from their cash flows from operations. They didn't have to borrow anything, and they didn't have to issue any new stock. Now, obviously, the stock that they issued was for the benefit of employees, they're telling you here. So notice, my cash went up $212 million. I started with $881 million at the end of the next year. That's typical for companies like that to close their books at periods other than the calendar year end. They have a year end of February 2nd. Kind of odd there. Usually it's at the end of the month, but they must be working with exactly 52 weeks each year as their reporting period. So we had a final cash balance of $1,093 million. Very important is that you understand cash basis versus accrual basis accounting. Now, when it comes to cash basis accounting, here we're looking at cash receipts and cash payments. This is what we do on the cash flow statement. This is what we see under my operating cash flows. Accrual basis accounting is a different monster. This is what you see on the income statement. We look at revenues and expenses, and it doesn't matter when we received or paid out the cash. That's called my net income or net loss. In other words, there's a lot of expenses that you're recording that you haven't paid yet. There's situations where you have accounts receivable and you haven't received the money yet, but you're picking it up as revenue. So there's a big distinction between cash basis accounting and accrual basis accounting, but both are important. As far as the income statement is concerned, the statement of cash flows, both measure operating performance, but they do it differently. Statement of cash flows uses cash basis, as I said on the prior slide. Income statement uses accrual accounting. Both are very useful. I somewhat favor the cash flow number from operations more than net income because there's no estimates involved. None whatsoever. It's more objective. And that's why I always look at whether or not the cash flows are fairly close to net income, and if they're higher, I'm all the more happier. That tells me I have some trust in their income statement. So both of those statements are very useful. to users out there. And you'll see how these statements have an impact when we look at that third chapter on financial accounting. With regard, just to review that you understand what are some investing activities, inflows and outflows. Well, inflows would be you're selling off equipment, buildings or land or any other kind of long-term asset. If you're selling off investments, and if you're collecting on loans that you made to other parties, those would be all sources or inflows of investing activities. Outflows would be just the opposite. Instead of selling equipment, buildings and land, you're purchasing long-lived assets in the business. These are often called capital expenditures. Not that they have anything to do with paid-in capital or owner's equity, but you're buying assets that are lasting for a longer period of time, or you could be purchasing investments in stocks and bonds. With regard to financing activities, summarizing all the inflows, well, you sell shares to the owners, meaning they invest the shares directly from the money into the company and buy the shares directly from the company. Or you're borrowing money from creditors through notes, loans, mortgages, and bonds. What are some outflows under financing activities that you'll see when you're looking at annual reports? Dividend payments and other distributions to shareholders. You go back and buy your own shares in the market, like Lulu did there. Or was it another company? I'm sorry, yeah, it was the other company that was buying back your shares, not Lulu. And of course, you have the repayment of principal amounts of debts, whether it's on bonds, mortgages, long-term loans. Now, obviously, if they're trade payables, such as accounts payable, taxes payable, interest payable, that's under operating activities. This is principal amounts on debt to your creditors. And finally, we have the statement of stockholders' equity to wrap up this chapter. Basically, what's new with the statement of stockholders' equity, they introduced the idea of a par value, which is no big deal, and how much the shares sold over par. But the idea is simply this, and that's why I said before, some companies don't even break this down. But your shareholders invested I should look at the bottom here, in all $356 million into the company. Notice their earnings retained or kept in the company is much higher. Oh, and also instead of listing the treasury stock as a separate line column, they show the stock repurchase as a reduction in retained earnings. Now, some companies handle it that way. Other companies don't mess with retained earnings on that. They just show treasury stock as another line item where they're deducting it, not line item, but a column total. And then they would still come up with the same stockholders' equity. So you'll see two variations on that. Some companies lower their retained earnings. Other companies just have it as a separate line item. Accumulated other comprehensive income, what did they have here? They had a foreign currency translation loss this year because it's in parentheses. Why they would not want to run that through retained earnings is because if you have foreign operations, odds are you're converting the foreign dollars, euros or pesos or whatever, into US dollars. There's always going to be fluctuating translation gains and losses on those currencies depending on how the US dollar is fluctuating with the other currencies. That's something that's going to happen every year, and you don't want to run that through on your income statement. So that's why they show it under accumulated other comprehensive income. Another example would be, let's say, a long-term investment that fluctuates in value on any particular day. You don't want to run that through on your income statement. But when it's all said and done, your total stockholders' equity will add up to all those components. So they threw in three new items, having the common stock broken down between the common stock and the paid-in capital in excess of par. The idea of you buying back your stock, where you could lower retained earnings for that or have a separate column for treasury stock, because you're literally buying back your shares. We talked about that on the statement of cash flows. And then your accumulated other comprehensive income, where these are just items that you're not running through in retained earnings because they're long-term in nature. But there's a statement on that, which I don't care about or even mention in any detail in this course. But that is something that you shouldn't spend any kind of effort in trying to understand or getting into details in even reality if you're looking at an annual report. And that is it, of course, for this particular chapter. Make sure, as usual, you work